Good morning, everyone. Good morning, Peter. I'd like to welcome you to the Microcap conference. Today, Peter will be speaking on the outlook of the 2024 economy and its effect on microcap companies and investors. Over to you, Peter.
Hi, welcome everybody. So I want to talk about the true state of the economy and what it likely portends for your investments. So first of all, there are two main things that the conventional wisdom has wrong. One is that the U.S. economy is strong. We have avoided recession. The Fed has pulled off a soft landing. None of those assumptions are accurate. In fact, if we're not already in a recession, we soon will be. And it's not going to be soft. It's going to be the worst recession that we've had since the Depression. It will be worse than what we call the Great Recession, which is the one that followed the 2008 financial crisis. In fact, it didn't follow the crisis. It actually preceded it, because the Great Recession began in December of 2007. But if you recall that time period, the government did not acknowledge that the economy was in a recession for an entire year. It wasn't until December of 2008 that the recession was declared. And what happened was the government went back and downwardly revised an entire year's worth of economic data. Because prior to December of 2008, the government data was telling us that the economy was in good shape, just like the data supposedly is telling us now. But then they went back and they revised it all, and they said, you know, we've actually been in a recession for an entire year. All the data that you relied on was wrong. And that was the worst recession since the Great Depression. That recession was the consequence of Fed policy. The Federal Reserve lowered interest rates down to 1% in 2002, following the bursting of the NASDAQ bubble, the terrorist attack on 2001. We had a recession, so the Fed came in and cut rates to 1%, left them there for a couple of years, and then was slow to normalize back up to about 5.25%, 5.5%. And during that 4 or 5 year period, we inflated a housing bubble. And when that bubble popped, we had the financial crisis. And of course, that was obvious in the making. I was critical of the Fed's policy mistakes the entire time. I was even short the subprime market starting in 2006, and was able to make a lot of money in 2007 when that trade paid off. But the mistakes that the Fed made subsequent to the 2008 financial crisis have been much greater than the mistakes that it made that caused that crisis. It kept interest rates at zero for more than a decade, blew up its balance sheet with multiple rounds of quantitative easing. And so the economy is in much worse shape. And the banking system, ironically, is in far worse shape. The banks are more insolvent today than they were when they were bailed out in 2008. So we don't have a soft landing. I expect that we are in recession, and that at some point the data will be revised to confirm this, although a lot of the data already supports it. Even the government's data supports manufacturing in recession. It's been in recession for almost 2 years. In fact, the leading economic indicators have been negative for over 20 months. The only other time that's ever happened was during the Great Recession of 07 and 08. I think we're going to break that record of string of negative LEI. But just this morning we got massive layoffs announced, Challenger layoffs. We've been having a lot of layoffs. The only reason that the unemployment rate is so low is because so many unemployed people aren't counted. And the only reason we're creating jobs, other than the fact that the government is lying and the jobs aren't even being created, but the jobs that are being created are part-time jobs. and they're all going to people who already have jobs. We have had an explosion of moonlighting. You have a record number of Americans who have 2 or 3 jobs. One of the reasons is that they've lost their full-time job. We've actually had a net loss of full-time jobs over the last couple of years. We've simply replaced them with a greater quantity of lower-paying part-time jobs. And so you have people holding down multiple jobs, but that's where the job creation lies. And these are jobs that people would rather not have. They would rather have one good full-time job, but they have to settle for 2 or 3 crappy part-time jobs. But the government claims credit for all these, low-quality, low-paying jobs that are being created, and never accepts responsibility for all the higher-paying full-time jobs that have been destroyed. So that's number one: is the economy is much weaker than is generally perceived. But the other thing that the markets have wrong is the benign outlook for inflation. Inflation is actually much stronger than the markets believe, far from heading back down to 2%. And Powell, of course, had a press conference yesterday where he kind of rained on the March rate cut parade, but he still claimed that the Fed is on its way towards restoring its version of price stability, which is prices rising by 2% a year. But that's not going to happen. We're probably at trough inflation and have been for the past several months. The inflation curve is about to bend back up, and we're going to head back towards the high of 9% year-over-year inflation, which we recorded about a year and a half ago. But of course, the government official measures only tell about half the story. So if the government says inflation is 9%, it's more like 18%. And even when they're claiming it's 2%, it's more like 4%. And that's because by design, these measures don't actually capture the extent to which prices are rising. They're underreported. I think a much better indicator of what's happening to prices is just looking at the prices. Look at the import-export prices, and those prices were rising at about 18 to 20% when the government was claiming that prices were rising by 8 or 9%. Those prices have come back down a bit because we had a big rise in the value of the dollar. I think that rise is over. The dollar rose against foreign currencies in anticipation of rate hikes. Well, those rate hikes are now over. The only question is, when is the Fed going to start cutting? And so the support for the dollar is gone. And the rise in the dollar is the primary reason that we had a pullback in commodity prices. And that's what helped bring down the CPI. But commodity prices are going to surge anew as the dollar weakens. But the primary driver for inflation are the federal budget deficits and the ongoing need to finance them. Inflation is not rising prices. Rising prices are merely a consequence of inflation. Inflation is an expansion of the money supply. It's an expansion of credit, and the sole source of that is the Federal Reserve. And in fact, the entire time that the Fed has been pretending to fight inflation with its rate hikes, it's been stoking inflation's fires with credit. Credit growth has continued unabated on an individual level. Debt is at an all-time record high. Americans are using credit cards like never before. Credit card debt's at a record high. Total household debt is at a record high. Americans can continue to spend money that they don't earn to buy things they can't afford, and that bids up prices. But the biggest problem is at the federal government level. Federal deficits are off the charts. We've never seen deficits like this other than during the COVID shutdown. The deficits are enormous. The government is officially running budget deficits of about $2 trillion a year, but the actual deficits are twice as large, because if you look at the national debt, it's rising by closer to $1.25 trillion. And so all of this spending is fueling inflation, and all of it is going to be financed by the Fed. In fact, what I think is going to be the big pivot in 2024 is not the rate cuts, but the return to quantitative easing. In fact, during his press conference yesterday, Powell indicated that the Fed was going to continue to shrink its balance sheet. That is not going to happen. I'd be surprised if quantitative tightening goes much past March. All the focus is on, will the Fed cut rates in March? What I'm concerned about is, will the Fed continue to shrink its balance sheet past March? Because what happens in March is that its bailout plan for the banks expires. We would have begun a greater financial crisis than the one we had in 2008 last year in March, had the Fed not made the mistake of bailing out the banks. And I say it was a mistake because it's just made the underlying insolvency problem worse. The reason the banks are in worse shape now than they were in 2008 is, in 2008, the problem was bad residential mortgages that defaulted because real estate prices were down. And so the banks lost money on mortgages that went into default. Well, now it's a much bigger problem. It's not defaulting mortgages that are the problem. It's all the mortgages, because this time it's not real estate prices that crashed, but mortgage values that crashed. And it's the mortgages that the banks own. Their customers or their borrowers own the homes. So the borrowers have the asset that is appreciated, while the lenders have the asset that has collapsed in value. And so the banks are in much worse shape on their residential mortgages now than they were in 2008. And they have a commercial real estate problem, which didn't even exist in 2008. There was no problem with their commercial loans. In fact, those loans gained value as interest rates went down, and that increased commercial real estate prices. Well, commercial real estate prices have collapsed, and that's the collateral for all these loans that are going to go bad. And the banks are going to lose trillions on these loans, because the properties have collapsed in price, because people are working from home. So a lot of the commercial real estate is vacant. You also had a huge bankruptcy for WeWork, which was a major owner or tenant, which is now in bankruptcy and not paying. And then for the retail space, you have the fact that so many malls and shopping centers are empty or half empty because people are shopping from home. But they're not just shopping from home, they're shopping less. That's one of the reasons that UPS announced major layoffs the other day. It's not just because the labor costs went up, it's because the volume of shipping is collapsing. And why is shipping going down? Because we're in a recession. That's why we're in a recession that our leaders in government or people on Wall Street refuse to acknowledge, because it's in their own interest to pretend that a weak economy is actually strong. But the anecdotal evidence is very strong that we're in recession. But the key is that inflation is going to come back. And a lot of people believe that, well, if we have a recession, well, at least the silver lining to that cloud is that inflation is going to come down. No, the recession is actually going to be a catalyst for even higher inflation, because what's going to happen in the recession, when it's officially acknowledged, is the Fed is going to cut rates. The Fed is going to do more quantitative easing. That's going to crash the dollar. That's actually going to tank the long end of the bond market. It's going to put upward pressure on interest rates throughout the economy as inflation premiums have to rise, because you're not going to loan money out at a low rate of interest when you have double-digit inflation destroying the value of your purchasing power. That's normally what happens. People are wrong to think that a strong economy creates inflation. It doesn't. It's a weak economy that generally causes higher prices, because it results in more money printing, which is really the source of inflation. Now, one way that the free market overcomes inflation is through growth. Because if the economy is growing and it's more productive and it's producing more goods and services, it can absorb the inflation that the government creates by printing more money. But it's when you have a weak economy that is less productive, that is not producing more goods and services, but produces fewer goods and services, that's when you have even more upward pressure on prices, because you have more money created by government, but fewer products created by industry. And so you have even more upward pressure on prices. So that's what we're going to have. Some people want to call it stagflation because that's what they called it in the 1970s. This is going to be similar, except a whole lot worse, because the economy is going to be much weaker in this decade than it was during the 70s, while inflation is going to be much stronger. And we are entering this stagflationary period in a much weaker financial position than we had in 1970. In 1970, at the beginning of that decade, the United States was the world's largest creditor nation. Today, we're not only the world's largest debtor nation, the United States owes more than all the other debtor nations of the world combined. In 1970, we were running large trade surpluses. Now we won record trade deficits. We have trade deficits with every country in the world. We had a lot more savings in 1970. Households had much better balance sheets. The national debt was a tiny fraction of the overall economy, unlike today, where it's 125% of the economy and rising. In 1970, we had a lot of women who didn't work, and so they represented potential labor that could enter the economy. Remember, before 1970, married women, by and large, did not work, because their husbands could afford to support them. But as the economy weakened throughout the 70s, and as inflation eroded away the value of the husband's paycheck, the wife was able to step up and make up for the loss. She was able to go get a job and earn the money that her husband was no longer earning. But that was like having a reserve, a labor force that really helped the economy, because now these women could come in. We had more people working. But we don't have that because most married women already work. And now people are working multiple jobs. So we don't have that. We have a large portion of the labor force that is detached from the labor force, but they're not going to come back in. They're gone. And so the economy is in far worse shape. Plus, I think in 1970, the dollar was the reserve currency. We went off the gold standard in 1971 to avoid having to have deflation, and we had massive inflation instead. But even though the dollar lost about 2/3 of its value as a result of that, and you saw oil prices go up tenfold, gold prices go up 20-fold, the dollar remained the reserve currency throughout that period. It just lost some value. But I think today, the dollar is on the verge of losing that status completely. And I think when the world goes off the dollar standard, it's going to be even more harmful to the U.S. economy than when the U.S. went off the gold standard, because our economy has evolved into this service sector economy over the decades that can't exist without the dollar's reserve currency role, because that's what enables the trade deficits. That's what enables Americans to live beyond our means. That's why Americans can consume so much and produce so little. That's how come Americans can borrow so much and save so little. But once that privilege is removed, the whole phony economy that was built on top of it is going to come collapsing down. So to try to sum it up for how you need to incorporate this into your investments is you need to understand, the predicament that people are going to be in with high inflation, higher nominal interest rates, lower real incomes. People are going to have to cut back dramatically on their discretionary spending. So businesses, particularly smaller businesses that rely on that spending, many of them are going to go bankrupt. There's going to be a lot of loans that are going to go into default. A lot of companies that have borrowed money are not going to be able to pay it back. This has to be a big part of the investment strategy. You have to think about what did well in the 1970s, commodity-based investments, real assets, foreign assets. Look towards Asia, Southeast Asia, South America, emerging markets did extremely well during the 1970s. I mean, if you invested heavily in Asian stocks, you made a killing. If you invested in commodities, oil, gold, you made a tremendous amount of money. But if you stuck with the stocks that worked in the 1960s, the Nifty 50 type of stocks that drove the Dow up to 1,000 in 1966, you got killed during the 1970s. In fact, the record low for the U.S. stock market was in 1980, when it was down at 80 to 82. I forget the exact year, but the Dow was worth less than 1 ounce of gold. That was the lowest it's ever been. It was actually slightly lower than the 1932 low for the Dow in terms of gold. And I think this financial crisis, this recession, depression is going to be so bad that we could easily see the Dow Jones back to the vicinity of 1 ounce of gold again. And if you could imagine, what that means, the Dow is close to 40,000 and gold is at about 2,000. So the ratio is now about 20 to 1, which is about where it was at the peak in 1929 before the crash. The all-time record high, by the way, was 2001, when the Dow was worth more than 40 ounces of gold. So we're not going anywhere near that level again. That was during the dot-com bubble. But we're still extremely expensive for the Dow in terms of real money. And so it has a long way to fall. And obviously, smaller cap stocks are probably even more vulnerable than those names. So you have to just tread very lightly on the companies that you invest in, to the extent that you can find companies that export where their customers are outside the United States. You'll probably do much better, because it's those consumers, the emerging market consumers, that are going to be a lot wealthier in the future. They're going to have enhanced purchasing power, and so they're going to be better positioned to buy stuff. Americans are going to be broke. They've run out of credit. They've run out of purchasing power. So Americans are going to have to, live beneath their means for many, many years to try to dig our way out of this hole, if it's even possible, because a lot of it might depend on the political environment and how the government responds to this crisis, because they certainly have the capacity to make it a whole lot worse by blaming everything on capitalism and coming up with all sorts of new regulations and government programs to supposedly solve the problems that will simply make them a lot worse. I think I've used up my 20 minutes looking at my clock. But anyway, if anybody has any questions, they can reach out to me. If they want some help trying to manage funds. I mean, I manage mutual funds and separately managed accounts that try to account for all of these themes and all of the macroeconomic events that are going to be playing out in the years ahead that the mainstream is completely unprepared for. Just like they were unprepared for the 2008 financial crisis, they're even more unprepared for this one because they still don't understand why we had that crisis, and they still don't understand everything that the Fed did to create it and everything they've done subsequent that has made all the underlying problems worse.
All right. Thank you, Peter. We appreciate that honest, cold water in the face assessment, but the truth will set us free, so we will act accordingly. Thank you so much for your time this morning.
All right.
Appreciate it.
All right. Take care.